Everyone, my name is Carlisle Skill. I'm the Chief Investment Officer of Microequities Asset Management. My colleague Andrew Ross is the Portfolio Manager for our private equity strategies. Today, our presentation discusses our 1-for-5 rights issue in the Microequities Private to Beyond the IPO Fund. We're going to be covering really three main areas in today's discussion. The first one is why are we doing a 1-for-5 rights issue? Secondly, the significant opportunity set within the existing portfolio. As some of those assets get closer to a maturation phase, there's going to be significant opportunity for a revaluation in the ensuing 6, 12, and 24 months. And thirdly, the most exciting and best opportunity set in terms of our investment opportunity pipeline that we've ever had since the fund's inception. Now, we'll be pausing the webinar every few slides to give the audience an opportunity to ask questions specifically about this fund, and we'll do our best to answer those questions as faithfully and accurately as possible. Just a quick summary overview. The fund invests predominantly in B2B technology companies. The revenue profile of those businesses are usually within a range of $5 to $15 million annual recurring revenue. The fund so far has returned 18.8% after all fees. We deem that the rights issue that we're undertaking will be the lowest price point that the fund will be in from now till the future periods. We've achieved 3 material exits, and we'll be discussing the return profile of those 3 exits. And importantly, we think there are some near-term catalysts that will likely trigger revaluation events within the existing portfolio. So I'll go quickly over this. This is just an overview of the target market segment that the fund focuses in. So to the left, we really have the venture capital sub 5 million revenue profile type businesses. That category or market segment is much more suitable for venture capital type funds. To the right, we've got more maturing businesses, typically north of $20 million of annual revenue. And we focus in what we call the growth market segment, where they've got a proven product, they've already got quite an established client base, but they're looking for growth capital to assist them in that journey. And we typically take stakes between 5 to maybe 20% of the equity. Typically, these businesses are founder-led. The founder is still usually the main shareholder, but they want some external assistance. They want people that are going to help them drive the growth, not only with capital, but also with technical assistance, with business networks, with human resource talent recruitment, a whole set of corporate expertise that can assist them and accelerate their growth profile. This is just a slide that discusses our investment management team. In all my presentations, what I call out is that we've never had anybody leave our investment management team. This is the same investment professionals that have been running our strategies from day one. And so we're very proud of that record that we've been able to keep all the talent within Microequities. I should also say, in the circa $600 million that we manage, by far the biggest client set are the principals, the investment management team, the board of directors, and Microequities with its own balance sheet. We speak for circa 120 million of the 600 that we manage. And I should also state that we pay full fees in those investments. We don't have an employee discount. We're paying the same rates as everybody else. So it's all at arm's length. And I think the fact that we've got such a significant amount of our personal wealth creates huge alignment. Sometimes some of our peers say that they've got alignment, and when you ask them how much they own of the total funds under management, it's 1 or 2%, whereas we speak for circa 20%, and that is a very large amount of the funds under management. And I think what that significant co-investment does is it makes us extremely focused on the downside risks of any investment that we undertake, whether it's in the private equity space or in the listed space. We are incentivized to pursue returns on behalf of our shareholders, but being a really good investor is about risk-adjusted returns. It's about delivering a return per unit of risk. And by virtue of the fact of having such significant personal stakes in our products, it makes us acutely aware of that downside risk and the relationship between reward and risk. So I think it's a very significant attribute.
So today, this is what the private to Beyond the IPO fund portfolio is composed of. We have 12 private investments within the fund, and a small amount of cash remaining, which we anticipate will be deployed into one of the fantastic opportunities that we will discuss today. Importantly, 56% of the private investments in the portfolio have been sourced through our proprietary exclusive network. That's CEOs and past CEOs of companies that we've been partners with through the listed space as well as the private space, through our own investor base who have a lot of business interests themselves. And in our pipeline, we're seeing the same dynamic where a lot of the opportunities are coming through that proprietary network.
Just a reminder that if you want to send us a question, there's an icon with a question mark Q&A at the bottom of your Zoom screen. You can click that, type a question, and we'll pause the webinar every few slides to answer those questions.
So today, within the existing portfolio, 52% of the portfolio is held at cost. That's 8 of the 12 private investments. Importantly, 5 of those 8 that are held at cost are recent investments. And we're seeing good growth within that portfolio, which we'll discuss throughout the presentation, and see significant opportunity for revaluation within the portfolio in the future.
But I think we sometimes get questions from investors asking us, there's little movement in the unit price. They want to see the unit price increasing. And we understand that. We periodically review the valuations of the entire portfolio, as we have to do within the accounting standards, and we have to exercise consistency and professional judgment in valuing those assets. Now, fund managers earn management fees on the basis of the net asset values. So we have a strong incentive to revaluate the assets upwards. However, in our professional judgment, we deem to take a conservative application of what is fair market value, and we don't want to pursue an aggressive accounting or valuation policy that may result in future write-downs. If anything, it would be arguably that we err in the side of conservatism, despite us having a strong commercial incentive to revalue the assets. However, specifically as the vintage of this portfolio starts to mature, and we are at a point where some of our assets are maturing, we will need to mark some of these assets at fair value, and that's just a natural progress of our periodic revaluation of the assets. But we have been applying a very consistent approach to our valuation. We don't want to aggressively assert valuations that may put our investors at risk of future write-downs. We want to create scenarios where we are writing up the assets as opposed to down, and we'll do so when we think we have significant confidence that the revaluation of those assets stands a true test of fair market value. We'll just pause there because I think we've got a question. We've got a question regarding corporate activity in Complexica. This was a flagship investment when the fund was initiated. Can you please comment on this scenario? Yep, we can. So Complexica, there is an announcement on Complexica regarding a potential acquisition by Prophecy. There has been recent ASX updates saying that there are ongoing negotiations between Prophecy and Complexica. Given Prophecy is a publicly listed company, I'm not at liberty to go into details because it's not in the realm of the public knowledge or the public domain. What I will say is that we are very comfortable with the valuation that we have on Complexica, and we will undertake a periodic revaluation of Complexica as all other assets. But we are very comfortable with the current valuation of Complexica, and with regards to the potential or the potential Prophecy acquisition of Complexica, we expect Prophecy to make some announcements over the short term. But outside of that, unfortunately, we're not allowed to comment further.
So the slide here is discussing the three of the material exits within the portfolio. So our strategy has been that, where we invest in a business and we see that it is really performing strongly, that we double down on our high-performing investments. So across all three of these businesses, we invested 3 times in each of them along the journey. And each time we invested, the return on that additional capital was significantly higher, as you can see by the 3 bar charts. So we will continue to do that to back our winners and to create value for shareholders. The other point to make here is that when we are investing as a growth equity investor, we're buying a minority stake in these businesses. But when we're exiting these businesses, it's through a control transaction, and that control premium contributes to the returns that we're generating. And across all 3 of these businesses, there was a control transaction. CourseLoop was acquired by Technology One, an ASX-listed education technology provider. FoundView was acquired by an international payments business looking to come into Australia, and Instant Scripts was acquired by Wesfarmers. So these businesses, as they start to scale and grow, are in high demand from strategics within their verticals.
Coming back to our proprietary source of deal flow, and this is one of the advantages of being the fund as the fund matures. Because of our success with CourseLoop, it opened up a pathway to invest in a competitor of CourseLoop once we had fully exited the business and therefore had no conflict of interest. The management of the Global IT Factory, which is a competitor to CourseLoop, took note of our investment success, and through that investment, we got to know the management, and there was an opportunity for us to back Global IT, which I think is about 6 months into our investment, and the business is doing really, really well. And we've been able to leverage some of our knowledge and skill set of our investment experience in CourseLoop to bring and contribute to the growth path of Global IT Factory. But that was an exclusive proprietary deal that was on the back of the success with CourseLoop.
So this gives you a snapshot of our existing private portfolio today. And what we wanted to call out is the significant revaluation opportunities that there will be within that existing portfolio in the future. So just to carry on from Carlos's point, Global IT, we've only owned that business for 6 months, but have already seen a 27% revenue increase in that business through a number of new contracts that they've won both in Australia and Asia. It's still early, but as we look at our valuations in the future, we would expect, if that continues, that there will be a revaluation of that asset at some point. Axe Group is a insurance technology software that is expected to list on the ASX within the next 6 to 12 months. And because of the structure of our investment, upon IPO, we'll see a 54% uplift in the value of our investment in Axe Group. Lumery is a platform for NDIS service providers to manage their business. And that business has grown into the US market and is scaling very fast in the US, and has just won a significant contract from their major legacy competitor in the US. So as that US business starts to gain traction, there's an opportunity for revaluation of Lumery at some point as well. And across the rest of the portfolio, I can't name them specifically at the moment, but one of the businesses we expect will go through a sale process within the next 12 months that will generate a strong return for the fund. And another business is going through a Series B capital raise, which we anticipate will, if completed, will be done at a significant uplift to the valuation that we are currently holding the business at in the fund.
Medical First Group is another business that is of a older vintage that we have so far held at cost. We've determined to hold that asset at cost because the business wasn't of a scale where it was a genuine platform, and therefore we didn't deem that it warranted a revaluation of that asset. However, that business is scaling nicely in terms of the number of practices and full-time doctors, so there is potential there in the next 6 to 12 months to significantly revalue that asset. And Andrew, maybe you want to talk to some of the Medicare changes as well that will provide a very significant revenue tailwind for that business.
So from 1 November this year, 2025, the government's triple bulk billing incentive commenced for all GP practices, but that's where the clinics are bulk billing. And all of our Medical First Group clinics, of which there are 14 now, are located in regional hubs where that bulk billing incentive is higher. And it makes sense in a majority of our clinics to convert to bulk billing. So as we see those clinics convert to bulk billing, we expect to see a material uplift in revenue over the next 12 months.
So when I made the statement earlier on about the revaluation potential, both in the short term and over the next 24 months in the portfolio, I think the reasoning that both Andrew and I have provided in this slide should give investors and potential investors great comfort that it's not a throwaway comment. These are actual, very likely probable events that will result in a material revaluation of our existing portfolio. And that is very exciting because as the vintage of our older investments start to mature, we have a genuine case to revalue those assets objectively and at fair value. Just take a pause here because I've got quite a few questions that have come up. I'll deal with the easiest one first. Matt has asked if these slides will be available post-webinar. Yes, we will be making those slides available, and this webinar is being recorded, so you should be able to access the entirety of this presentation. Got a question from Chris. Do you take board positions on these investments when you take 20%, so you have a better understanding of the business?
Yeah, so in most cases, we do take a board position or a board observer right. In some cases where we are a smaller investor in the company and we know that there are other like-minded institutional investors that are on the board, we may not have a board position, but we will always have access to information.
Got another question from Erica. Are the majority of these companies software medical based?
So we do like health tech as a segment, and so have invested in health tech a number of times. For instance, Instant Scripts was a great outcome. Lumery is in that same space, and Medical First Group. But they're not all within that health tech space, but it's definitely a segment that we do like because it is non-discretionary and is a very big market with a lot of opportunity for technology to disrupt.
I have another question from a different Andrew. Can you update on how Automentum business is going, please?
Automentum is one of our star performers within the portfolio. It has been growing very strongly over the last number of years. The business has now over 1,000 suppliers and over 40,000 venues using the platform to facilitate ordering between venues and suppliers within the hospitality space. So it is now becoming the dominant platform within the Australian market, but there is still significant growth potential within that business. It still represents a small part of the market. And as you start to see the number of trading relationships between those suppliers and those 40,000 venues grow, we expect that business will continue to really do well.
And Andrew, I'll further add on that. The fact that we've made several additional investments in Automentum should give you great insight as to how confident the investment management team is on that investment. I'll just put this slide back. These are the 3 exits that we've done, that we've achieved, 3 material exits that we've done so far. And in all these 3 investments, we made an initial investment, then we made a second investment, and then we made a third investment. So that's part of our investment style. We put money in, the investments do well and they require additional capital. We continue to support them through that journey. And typically once we do that second or third investment, the investment thesis has been significantly de-risked. The business has strong momentum in terms of its growth profile. And you see there in that slide that actually the second and third investments that we do have actually delivered the highest internal rate of return. So the fact that we've undertaking various investments in Automentum, I think, should give you confidence that the investment management team is very happy with how that investment is going. I've got more questions. This one's from Simon. Is this raise unusual? Have you raised money previously in your closed-end funds?
So this is the second raise post the opening of the fund. We raised an initial quantum, invested the majority of that capital, and then we reopened the fund periodically. So it's only happened twice since the establishment of the fund, where we see great opportunities for the fund and want to be able to take advantage of those opportunities for the investors.
Quick question from Martin. I'll probably answer this. In the last 4 years since the fund's inception, only 4 investments have been revalued. What is the estimated timing for revaluations in the other investments? Martin, it's actually been more. So there's 4 within the existing portfolio that have been revalued. But if we go back to the earlier slide, all the exits that we've undertaken, all those investments have been obviously valued at those exit prices. So it's more than 4. It's a considerable amount. As Andrew said earlier, there's been a significant number of the investments that we are currently holding at cost that were undertaken in the last 6 months. That is just too early for us to take a view on a revaluation event. We are conservative by nature. We're not going to put forward aggressive revaluations to appease investors that all they want to see is the upside. We're going to take a conservative approach, despite the fact that we've got a commercial incentive to revalue the asset. We will decide conservatively, and we've been consistent in our valuation approach. We don't want to undertake write-downs. We want to undertake write-ups, and so we'll continue to apply a consistent valuation methodology and fully observant of the regulatory framework that we adhere to. There's a question from Brent. Are all 3 Automentum investments held at cost?
So yes, they are. 2 of the 3 investments have been made within the last 6 months. And so, those investments are, too early really to look at a revaluation. But as the business continues to perform, we will look at that valuation closely and consider whether it justifies a revaluation.
Question from Jonathan: with your subsequent investments on positions exited, given their higher IRR, are they made at lower prices valuations?
Is the question on the initial investment?
No, I think they mean the secondary and third investments, were they done at lower valuations?
Oh, no, actually quite the opposite. The second and third investments were made at higher valuations. But as we see the businesses continue to perform, we're happy to back the businesses at those higher valuations. And then, because the businesses are starting to scale faster, we see an even better result from those subsequent investments.
Question from Chris: valuation seems to suggest opportunity or conservatism, but what is the time horizon for ability to convert realization? We've covered that, but I think probably just re-emphasize the key ones that you see within the next 6 months, even though we think over the next 24 months, there'll also be significant revaluations, but there's certainly near-term opportunities for revaluation. Andrew?
Yeah, so I mean, the 3 material exits have been within the last 18 months. I think 2 of those were probably within the last 12 months. And sort of as the portfolio is maturing, I think we will see like a consistent number of revaluations and exits, over each 12-month period going forward now. So, within the existing portfolio, we expect an exit within the next 12 months. And the Axe Group, we expect to IPO. So whilst that won't be an exit, there will be a sort of liquidity event that will result in a significant uplift in that valuation.
Question from Joe: are you going to continue to raise additional funds in this fund, i.e. a perpetual fund, or would it be closed after this raise and run to completion with exit proceeds being returned to investors? So the fund has returned capital to investors. Any year in which there is a realization of gains, those gains do have to be distributed to investors. So there is capital from the original principal that was raised that has already been returned. The fund is a perpetual evergreen fund, which means there might be periodic opportunities that if the investment management team deems merit-worthy to raise capital, we will do so. And like I said earlier, this is without a doubt the best pipeline of investment opportunities that we've ever come across since the fund's inception. And we're going to go into greater detail in this presentation to actually articulate why we're so excited about that opportunity set. Question from Martin: is there a minimum time that the rights issues need to be held for, Andrew?
The fund has a 5-year lockup period, and so that will apply to the rights issue.
Okay, got a question from Paul: how do you reconcile your comments that your portfolio is conservative valued with undertaking an entitlement offers at NAV? Aren't you effective penalising existing investors that don't take up the pro rata entitlement? Well, I think the fact that it is a rights issue is an opportunity set, and we're providing that rights issue first and foremost to our existing investors that have the right to fully participate in addition to their entitlement rights, or participate at a lesser amount or not participate. And I think the fact that we're doing that to our investors provides an equal opportunity set. Now, in terms of the valuation approach, I think we've taken a very consistent approach to our valuation. We do periodically review the assets. The reality is that 6 assets have been recently acquired at less than 6 months, and they are held at cost. Other assets like Medical First Group, it did not scale to a sufficient degree where it warranted a revaluation of that asset. That may change in the next 12 months. So I think we've been very consistent, but we do periodically revalue the entirety of the portfolio. We think we're comfortable with the approach that we've followed thus far. I'm going to take a pause. There's still 2 more questions which we'll come to, but I think we've got to keep going through the slide deck given the time constraints.
So we just wanted to spend a moment to take investors through some of our recent investments that we're very excited about. So the Axe Group is an insurance technology software. It has fantastic clients like MetLife, AIA in the life insurance market. We've invested via a convertible preference share, which will have a 54% uplift on conversion at an IPO, and we expect that IPO to be within the next 12 months. That business is continuing to perform strongly since we invested. It's achieving revenues in excess of $25 million per annum and EBITDA in excess of $6 million per annum. It's been growing strongly at 34% per annum and is led by a very experienced management team that Microequities has a long relationship with through our investment in Empire in the listed market, and is through that relationship is why we were afforded this opportunity. Automentum, we spoke about already. What maybe just to add to that, it's that the structure of our investments provides really good opportunity for revaluation as well. We have a convertible note at a 12% interest rate that has 33% upside on conversion. And we also bought some secondary shares opportunistically, that the structure of that investment means that it should deliver a minimum IRR of 30%. So Automentum is now a significant asset within the fund, representing 11.4% at cost. Global IT Factory, Carlos mentioned, it was a competitor to CourseLoop, where we had a fantastic investment exit at an IRR of 33%. Since our investment 6 months ago, they've already signed 2 new contracts with major universities in Australia and Asia. The business has been growing phenomenally quickly at 50% plus per annum, and is expanding into the UK market, which we see is a fantastic opportunity for the business and follows on our experience with CourseLoop as well. And finally, Javelin is another insurance technology software, but focuses on the broker market rather than to insurers directly. And that business is expanding rapidly in the Australian market. It originally comes from New Zealand. And so when we invested, the ARR is about $11 million per annum, but the business has already grown the contracted ARR to $18 million since our investment. And as they implement that contracted ARR and convert it to build ARR, that really underpins the growth of that business over the next 2 years.
We'll just pause here and take 2 more questions. One is from Robert. Please explain favourable structures and how they work. I think probably that. I think
Sure.
Liquidation preference and so on.
Yeah. So Javelin is a good example. So we've invested in preference shares with a 2 times liquidation preference. So firstly, the fact that they're preference shares means that on an exit event, those preference shares receive the proceeds prior to any ordinary shares that are held within the shareholder base. And the 2 times liquidation preference means that on an exit, we get back double or 2 times our initial investment prior to any ordinary shareholders receiving any proceeds. So at a minimum, we would expect to receive at least 2 times our initial investment for Javelin. And if the business outperforms, there's potential to achieve a greater return than that.
Got one question from Ivan. What is the long-term strategy for the IPO fund itself? Will you continue to roll into and out of new opportunities? Will the fund itself be ongoing? Yes, Ivan, the fund is an evergreen structure. That's how we've set it up. What we expect is, as the maturation and the scale of our investments increase, we will, upon exits, have larger and larger distributions of capital, and the investors will be able to take that capital in cash or reinvest in units. But we are a long-term player in this growth private equity phase. We think it's a very natural position for us to be in, because by nature, a lot of our microcap listed investments have very similar characteristics as to these type of businesses. And in fact, there's been very positive cross synergies, both from a research perspective and a business network and proprietary or deal flow that we've been able to originate, thanks to that cross-pollination between the listed space and this growth private equity space. So, 4 years into this strategy, we look back and said, and confidently say that it was the right thing for us to go into. And as we look into the fund right now, inside the existing opportunity set and the pipeline that we're going to discuss further, we think the fund is at an absolutely optimal stage to actually deliver very significant returns from this point forward. So yeah, we're excited, but we certainly feel that in terms of the industrial thesis, 4 years into it, it's absolutely been validated. Just to give you an idea of some of the cross-pollination we've seen, Andrew's talked about the opportunity set in ACTS, which came through a business network, a CEO, founder of Empire Limited, which is a business that Microequities invested in the publicly listed space. I think we held at 13 or 14% of the equity at some point. Before that business was bought out by Capgemini, which is a multinational French IT conglomerate. We were able to maintain the relationship with the key executives, and because of the great relationship and the longevity of our investment in Empire, we were afforded an opportunity to be the cornerstone investor in ACTS. But there's been also cross synergies in the listed space. So Andrew and the private equity team looked at an opportunity called Before Pay in the private equity space. The team decided not to invest for a number of reasons. That business then went on to IPO in the market. It had a tumultuous beginning to its life, but we kept on track. And obviously we had knowledge of that business through the private equity space and the work that the private equity team had done it. But the public equity team also monitored the evolution. I think it IPO'd at $2.20. The share price hit 45 cents. There was a change in the executive team and new CEO and management. The business matured. It became profitable. It was trading at a large discount. And then Microequities in the listed space became a substantial shareholder in that business. At that point as well, the private equity team also decided to take a material stake in that business. I think that stake was acquired between 45 and 50 cents. The share price of Before Pay today is well over $2.50. And I think that's less than 2 years old, that investment. So tremendous cross synergies and cross pollination of being in both strategies. I think the fact that some of these businesses that we own may go on to IPO will be of benefit to these private businesses, because we can help them navigate that journey, but also it will afford our publicly listed assets an opportunity to invest as well, having much better knowledge than we would have if they just started the IPO and we started to work on the research then. So it absolutely makes tremendous strategic sense for us to be in this private equity growth phase, given the domain expertise we hold in the micro and the small cap space as well. So I think I've talked about how excited and how genuinely excited we are about the pipeline. There's over $30 million of potential deal pipeline available to us. And we've highlighted 3 opportunities here that we are in quite advanced stages of DD. And we're going to focus the next few slides on those highlighted ones.
So this is a business that we have already secured the investment rights to. The business we actually looked at a number of years ago when it was doing maybe $2 or $3 million of revenue, and thought it looked like an interesting business, but just too early for the fund's mandate. And through that relationship, sort of kept in touch with the business, and what they've achieved over the last couple of years is really phenomenal. The business is growing at 80% year on year, fantastic net revenue retention, like clients don't leave and they're able to continue to grow the revenues to existing clients. They now have 500 plus customers, and there is an M&A opportunity that the business is looking at that has fantastic cross synergies for the business. They're also starting to expand into the UK market. And we intend to take up our rights in this business, and really excited about the opportunity. Another business in our pipeline that through our relationship is a non-competitive process. The founder has come to us and asked if we would like to support the next phase of growth of this business. We've known the business for over 12 months now, and they have continued to grow very strongly at 50% plus per annum, already with quite a strong business in the US market, which offers, significant market opportunity. And what we really like about it is that there are a number of growth drivers within this business. Not only are their clients growing through number of adding locations, they're also winning new brands, new clients as well. And then within each location, they're offering new products and driving additional revenues. And then if you layer on top of that new geographies and the US market opportunity as well, we think this is like one of the best businesses that we have seen to date, and would love investors to support the capital raise so that we can take advantage of opportunities like this.
So just on Andrew's last point about multiple growth engines, typically when we look at it as business as professional investors, we typically just see one growth engine, one driver that is actually providing the impetus for the business to grow and scale. Sometimes, in some very rare opportunities, we have what we call the dual engine. So they've got not just one driver, they've got two drivers. And that's always for us an additional element, a strategic element that we'd like to look for. It's seldom found, but you do sometimes have businesses that actually have dual engine drivers. And the great thing about that is that if one of those drivers, for whatever reason, runs into some issue, you still have another engine of growth that allows the business to continue to grow and revalue. It is extremely rare to find a business with three growth drivers. And that provides, and that's the reason why this business is growing at such a rapid pace, because it's not one engine, it's three engines, all in harmony, that are actually driving that top line growth. The fact that this business is already at a sizable scale from an annual recurring revenue, that the business provides mission critical software. And what I mean by mission critical, it sounds nice remark. But what does mission critical mean? Well, essentially, mission critical means that if you turn that software off, the business cannot function. It cannot operate. What the enterprise is established to do, it cannot longer do. So it's not a nice to have. It's an absolute essential piece of technology that underpins the enterprise mission. And so that's not discretionary. That's an absolute need. And when you look at the net dollar retention, which means when a contract of this business is up for renewal, what percentage of the dollar value do they retain? The fact that it's 130% means that when those contracts are up for renewal, they're adding more modalities, more technology, more solutions to the overall contract. And they not only retain that contract, but they upsize that client. And that speaks to a very important and high quality business. This business is already multi-geo, so that means that the glass ceiling of the business is not predicated by the domestic market share. It's got far higher addressable markets, which means that the growth runway of this business is very long. And these are all strategic quality elements that when a potential exit arises, any professional investor, whether it's an industrial buyer or a private equity enterprise, will actually assess and factor into the price that they pay. These are all high quality attributes to have. So this is generally a really exciting investment. a little bit of history in this investment. We were actually contesting to invest in this business about 12 months ago. We were unsuccessful, and we thought we were never going to be afforded an opportunity to invest in this business. A whole set of circumstances have arisen that it's now back into our laps, and we've been afforded an opportunity to invest and partake in this really exciting business. So we've been following this business for a long time, and we're super excited now that we've actually are going to be able to realise an investment in it.
And the third opportunity that we wanted to take you through today is a cybersecurity business that we have gotten to know this business over the last 12 months. The founder has really bootstrapped and built this business himself. He owns 90% of the business today. And the only reason that we have an exclusive term sheet signed is because he views us as a trusted partner to help him scale his business. It has taken 12 months to develop that trust, and we're at a point now where it is an exclusive term sheet with us. The business is growing at 40% plus over the last 2 years. It's in a massive market of cybersecurity with global customers. It is a profitable business, generating over $2 million in profit. And we think this is a very unique opportunity. So these are 3 fantastic investment opportunities. And why are we raising capital today? It's because we need capital to be able to invest in these opportunities and take advantage of them for investors in the fund. As an investor, I would like to invest my money into these businesses, and I hope that other investors will support us in that as well.
Just on this cybersecurity business, we should also add that the business is highly profitable. It doesn't actually require capital. It's actually been paying dividends to its founder shareholder over the last few years. We've been invited in because the founder sees us as a valuable strategic partner to help them grow their business, not only in Australia, but also in international markets. If you've ever listened to my webinars on our Global Value Microcap Fund, you would know that a few years back, we took the strategic decision to make cybersecurity software a key pillar of our asset class. I think we have more than 20% of the fund's assets. I discussed ad nauseum how difficult it is to find a cybersecurity business that we can invest in the ASX. To this date, we haven't been able to source and find one. The fact that we're going to be able to find and source a deal in the private space to us is incredibly exciting. This is a highly coveted sector by private equity funds. The businesses typically go through very, very expensive valuations. We're super excited about the technology set that this business has. They've got a great client base. We think we can help them accelerate that client penetration through our own business networks. We think we'll be able to add business partners to help them commercialize their products further in Australia. So we think we'll add a lot of expertise, but this is such a rare, unique opportunity. Andrew's been working hard on this relationship for the last 12 months. We think they've done a great job to get to where they are, but we think the future of that business is really, really exciting. So it's a really interesting deal. So got some more questions. So we'll just take a pause now and answer more questions. A question from Brett: can you share any details on the listed companies held in the portfolio? So mentioned before pay. Andrew, do you want to just maybe talk about GTK and Rubik Cloud, who's actually was mentioned in the financial review last week as well, and talk about those two?
Sure. So GTK provides software for large utilities. That entire international segment is dominated by legacy players like SAP and Oracle, and a lot of their technologies are old and not delivering the new functionality, cloud-based functionality that those utilities need today for complicated billing. GTK is one of only a few providers globally that can provide utilities with that functionality. We invested in that business when they were going through a real shift in their business where the UK market structure had changed. And so investors were not sure exactly on how that would play out. And that business has grown phenomenally since we invested over the last 2 years. And the reason we continue to be an investor is because the global opportunity of replacing those legacy players is enormous and has a long, long runway over the next decade at least. Reed Cloud is another business within the fund that was mentioned in the AFR just in the last week or so. They have two businesses within Reed Cloud. One of them is software for digital books for high schools, and the other is a vet education business where they offer courses to high school students. The vet business has been growing very strongly. The digital book business has also been growing. That business is profitable today. It is still a small market cap, but as they continue to scale, there will be further opportunities for that business.
Okay, got a question from Ian. We are all hearing all the successes. Have you had any failures?
Yeah, so I mean, as you can see on the slide here, there's a business, Opus Center, which was it hasn't been an exit, but to date has not achieved what we would have hoped it to. That business provides enterprise software to cemeteries and crematoriums. It's mission critical software. They have InvoCare as one of their largest clients in Australia. And when we invested, they raised about $13 million to pursue a number of new products, being delivering payments for their customers within their software. The founder and CEO of that business did not deliver on generating revenue from those new products and was terminated from the business. A new CEO has been brought into that business. That new CEO is very high quality. The reduction in the valuation reflects the price that they raised additional capital at to enable the new CEO to deliver on his strategic change in direction for the business. We did not participate in that capital raise. We are very strong on backing our winners and very careful about whether we continue to provide capital to businesses that have underperformed, so chose not to participate in that raise. Under this new CEO's tenure, that business may recover and do well in the future, but we've written down the value of that business to the last capital raise price, which was a significant reduction in valuation from where we initially invested. So disappointing outcome to date, but maybe a not revaluation opportunity in the future.
We're at 10:53. We're getting a lot of questions, but cognizant of our time. Unfortunately, I'm not going to be able to get through all the questions, which we do have a hard close at 11, but let's go through a few more questions before we just discuss the key terms. Question from Matt. If rights are not taken up by a portion of the investors, will those rights be available to other investors to purchase more in addition to the initial rights allocation? So there won't be more in addition to the rights allocation. We're doing a rights issue of approximately $14 million. That's the entirety that is available to, first and foremost, our existing investors. If, say, our existing investors only take up 10 million out of the 14 million, that 4 million not undertaken by existing investors will be provided to new non-existing investors. So we're not adding any additional capital other than the 1-for-5 rights issue. It's only the non-taken up portion that will be made available, if there is any, to non-existing investors.
But just to clarify, you can take up more than your 1-for-5 entitlement offer. So to the extent that others do not take up their rights, then you will be afforded the right to, on a pro rata basis, take up more of those rights.
Got a question from Matthew. Given you are investing in similar, albeit later stage investments, were there any learnings from the fund from the highly publicised strong room alleged fraud?
Yeah, I mean, I think it's always good to look at what is happening in the market and then reflect on how you can improve your processes internally. So we already carried out very thorough due diligence, and we were thinking, well, how can we enhance that due diligence? So one of the things that we do now is not just get the financials and the tax returns from the fund, from the businesses that we're looking at, but we actually get view access to their Xero. So we are directly looking into their accounting platform, so that we can directly look at invoices and see the funds that are in their bank account to ensure that bank statements aren't doctored or anything like that.
I think we'll take one more question and then I'll go to the key terms, just cognizant of time. Question from Joe. What is the current value of the IPO fund? How much do you intend to raise and how quickly will you deploy? Noting you mentioned $30 million pipeline.
So the current net asset value is about $70 million. As Carlos mentioned, we're raising a maximum of $14 million in this round. And we expect that will be deployed quickly because of the extent of our pipeline and the opportunities in front of us that we will need to take advantage of quickly if we want to secure them for the fund.
I'll just quickly cover the key terms. The sector focus, I think it's been well established that it is predominantly a technology-based or technology-enabled businesses where we tend to deploy the majority of the capital. There are some exceptions, and we will, from time to time, look at opportunities outside of that core focus. We're targeting returns of 15 to 25% per annum on the fund's invested capital net of fees. The capital raise rights is a 1-for-5 entitlement offer. It's approximately seeking to raise $14 million. The closing date for forms and application funds from existing investors need to be received by the 30th of November. You will be entitled to participate at the price as of the last trading day of last month. So that is the 31st of October's price. The term is open-ended. The redemption period is as is on the slide. There are annual distributions of any net realised income and gains. Those distributions can be opted in for a DRP or cash at the option of the investor. So we're coming up to 11 a.m. I want to thank existing investors for their ongoing support to the private equity strategy. I will say that Microequities Asset Management, who is an investor in the private equity fund, will be taking up the entitlement, their full entitlement of the offer. So will I, and so will my colleague Andrew. We deem that this will be the low point in terms of the fund's valuation because of the existing catalyst events that we expect to crystallise and materialise over the ensuing 6 to 24 months. We genuinely reiterate that the opportunity set and the three that Andrew has deep dived in are some of the most outstanding opportunities that we've had since we began the fund strategy, and they are excellent, highly qualified opportunities in which we've already undertaken a very significant amount of due diligence. So we think that as the cohort of our investments mature, you will see trigger events for revaluation as we do so. You should see realization of some of these assets as well. So once again, thank you everybody for taking time. I'm sorry I haven't been able to get through the entire Q&A. There has been a lot of activity, which is great to see. And I hope you all have a wonderful morning and great rest of the day. Talk soon.